This is Chapter 6, pre-class lecture on reporting and analyzing inventory. After studying this chapter, you should be able to determine how to classify inventory and inventory quantities. You should be able to explain the basis of accounting for inventories and apply the inventory cost flow methods under a periodic inventory system. You should be able to explain the financial statement and tax effects of each of the inventory cost flow assumptions. You should also be able to explain the lower of cost or market basis of accounting for inventories. You should be able to compute and interpret the inventory turnover and describe the LIFO reserve and explain its importance for comparing results of different companies. Okay, so the first thing we want to talk about is Learning Objective 1, determine how to classify inventory and inventory quantities. We need to talk from a bigger picture first when we talk about inventory. Talk about a merchandising company versus a manufacturing company. If you think about a merchandising company and what it is, basically it buys things from its vendors and then turns around and resells them. So I'll use the Gap, the clothing store. It probably buys t-shirts and shorts and dresses and whatever else the Gap sells from some sort of third-party vendor, buys them, puts a Gap label on it, sticks it on their shelves, and then turns around and sells it to you and I. So this is one type of inventory. Inventory from a merchandising company that's just purchased from somebody else and then turned around and sold. On the other hand, there's a manufacturing company, and manufacturing companies are companies who make and produce the products that they in turn sell to their customers. So for manufacturing companies, we have to look at three different kind of steps of the manufacturing process of the inventory. And so there are raw material, there are certain works in process, and then there are finished goods. For the purposes of 2301, this class, we're going to spend most of our time talking about inventory from a merchandising company. In 2302, you'll talk about a manufacturing company and break inventory down into the three pieces in the manufacturing process: raw materials, work in process, and finished goods. Regardless of what inventory you have, companies report all inventory under the current assets section on the balance sheet. Okay, so we talked about, inventory in two different environments, a manufacturing company and a merchandising company. Now let's talk about how we figure out the number of inventory items that we have. Before we can put a dollar value on the financial statements and say that, Coca-Cola company has $10 million of inventory and include that number on the financial statements, we need to come up with a quantity first. How many Coke bottles does Coke have? How much syrup do they have? And so what we need to do is we need to figure out the number and then apply a value to it. Well, one of the ways that we need to determine the quantity is by taking an actual physical inventory and take a count of the physical inventory that's in the warehouse. How many Coke bottles do we have? Well, let's go out and count them and check. And we take physical inventory counts for two different reasons. If we are running a perpetual inventory system, one that perpetually updates the inventory records in our that's a computerized system, if we go out and count all the Coke bottles, basically what that's doing is just checking the accuracy of the inventory records. So it's saying, okay, well, we have this perpetual system that constantly updates the number of Coke bottles that we should have. If we go out and count them, all we're doing is verifying if our numbers are right in our system. It also helps determine the amount of inventory that might be lost due to wasted raw materials or shoplifting or theft or any damage that might occur in the warehouse. So if there's a difference, if your records say that you should have 10 million Coke bottles and you go out and you count 9 million Coke bottles in your warehouse, you know that your records are off, but perhaps that's due to, theft or to damage or something like that, and you can adjust your records. If you're talking about a periodic inventory system, one that only periodically updates the number of inventory in your warehouse, when you're taking a physical count, when you go out into the warehouse and count the Coke bottles, you're not just checking the accuracy of the records, you're actually figuring out how much inventory you have on hand. So your periodic records probably haven't been updated since the last time you counted the inventory. And so in a periodic system, you're determining the actual inventory that you have on hand, and you're also determining the cost of goods sold for that particular period. So when you're talking about taking a physical inventory, going out into the warehouse, it involves counting, weighing, or measuring each kind of inventory on hand. So whether it's Coke bottles or Coke syrup or, whatever it is that you need to do, you need to count the bottles or weigh the vats of big syrup or whatever, so that you know how much inventory you have. And typically, inventory counts are taken when the business is closed or it's a slow period in the business, and it's usually at the end of the accounting period. So we've talked about determining the inventory quantity by going out and actually counting the inventory. We also need to talk about goods in transit. So I used Coke as an example. Coke, they put Coke bottles on trucks all the time and go deliver them to whoever buys them. They go to UTD and they fill up all the Coke machines with Coke bottles. And so we need to talk about the goods that are on the road between the Coke manufacturing plant and UTD. So these goods in transit are purchased goods that have not yet been received by the person who's buying the Coke, and these are sold goods. Coke has sold them, but they've not yet been delivered to their location. So goods in transit should be included in the inventory of the company that has the legal title of the goods, and legal title is determined by the terms of the sale. So when we've got goods that are on a truck, we need to figure out, should Coca-Cola be recording these items in their inventory, or should UTD be counting these in their inventory? Well, we've got two different terms that we use to determine who should record these goods that are in transit. And the first is called FOB shipping point, and the second is called FOB destination. FOB shipping point basically means that the ownership of the goods passes to the buyer when the public carrier accepts the goods from the seller. So FOB shipping point means that the ownership passes to the buyer the moment the truck leaves Coca-Cola's warehouse or leaves the seller's warehouse. So in transit, they are to be recorded on the buyer's financial statements. The buyer owns them if the terms are FOB shipping point, because the ownership passes the moment they leave the seller's dock. FOB destination, on the other hand, is when the ownership of the goods remains with the seller until the goods reach the buyer. So the actual ownership passes to the buyer when it shows up at the buyer's front door. So in transit, when it's on a public carrier, the seller still owns the goods. So Coca-Cola would still own the goods until it reached UTD, and then UTD would take ownership and record them in their inventory at that point. Okay, so we've talked about when we're coming up with inventory quantities, we've talked about taking a physical inventory count. We've talked about goods in transit. One more topic that we need to talk about when coming up with a quantity for the inventory, and that's consigned goods. You may have heard of a consignment shop before. Some of you may have actually taken things to a consignment shop. Consignment shop is basically where you can go and take something and drop it off, and what they do is you still own it while it's there. So maybe you take a nice piece of furniture that you no longer want, or maybe you take your prom dress that's really expensive but you no longer want, and you go take it to a consignment shop, and they put it in their front window, your prom dress, and try to sell it because you no longer want it. Well, they don't own it. The consignment store doesn't own it. You still own it. It's only when they sell it do they take a cut or a fee from that sale. So consigned goods are basically to hold the goods of other parties. So a consignment store would hold your prom dress and try to sell the goods for a fee, but without taking ownership of the goods. In the case of your prom dress, the consignment store doesn't own the goods. Many car, boat, and antique dealers sell goods on consignment, and you can kind of think about why. Consignment stores make money by earning that fee for the sale. The point of talking about consigned goods is that if you are a consignment store or you're selling things on consignment, you don't include those items like your prom dress in the inventory count for the consignment store. Okay, so we've spent all the time so far in learning Objective 1 coming up with a quantity for inventory. So you've figured out now how many items that you want to count in inventory. Now what we need to do is we need to cost them, to put a value on them. And believe it or not, companies come up with, there's 4 very popular ways for inventory valuing and costing inventory. Inventory is always counted for at cost, so whatever you purchased it for from your vendor, it's recorded at cost, and these costs include all expenditures necessary to acquire goods and place them in a condition ready for sale. Any unit costs are applied to quantities to determine the total cost of the inventory and the cost of goods sold using the following costing methods. So we're going to go through 4 different ways that companies value inventory. The first is called specific identification. The second is called first in, first out, or FIFO. The third is called last in, first out, or LIFO. And the fourth is called average cost. Okay, so to go through these cost flow assumptions and costing of inventory, let's use this example. Crivets TV Company purchases 3 identical 50-inch TVs on different dates at cost of $700, $750, and $800. And during the year, they sold 2 sets at $1,200 each. Okay, so if you look at the box, you can see that on February 3rd, they bought a TV from, their vendor, Mitsubishi or Sony or whoever, and it cost $700. And then they bought another one in March for $750, and then they bought another one in May for $800. And then in June, they sold 2 TVs. 2 of those TVs they pulled off the shelf and they sold for $1,200 each, or $2,400. So what we need to figure out is, of those 3 TVs, which costs should be assigned to the cost of goods sold, the 2 that are sold on June 1st, and which one should be left in ending inventory. What should be the value of ending inventory? Should we sell the 2 from February and March and leave the May one in ending inventory, or vice versa? Or should we add them all up, divide it by 3 and figure it out and get an average? So that's what we want to talk about in these inventory cost flows. Okay, so the first method, the specific identification method, is the one that's the most logical, but it's one that's actually least used. Under the specific identification method, basically if Crivets sold the TVs that it purchased on February 3rd and May 22nd, then its cost of goods sold is $1,500, the $700 February TV and the $800 May TV. And its ending inventory is $750, the one that was bought in March. So if companies use the specific identification method, they apply the specific costs of items to the cost of goods sold and the specific value of the one that was left behind that's still sitting on the shelf and leave it in ending inventory in the balance sheet. Under specific identification, it's the actual physical flow costing method, because you're actually pulling the items off the shelf and selling them and applying those to cost of goods sold, in which items still in inventory are specifically costed to arrive at the total cost of the ending inventory. And I mentioned in the last slide that this is relatively rare. Most companies do not do this. Most companies make assumptions, cost flow assumptions, about which units were sold. Companies that might use specific identification are ones that sell very large, very unique items, like maybe airplane sales or antique furniture sales, because antique furniture are probably all very unique pieces, and so you can specifically identify the costs of any antique furniture that you are selling. What most companies do is they use a cost flow assumption. And so cost flow assumptions does not need to be consistent with the physical movement of goods. And so we're going to talk about the 3 different cost flow assumptions: FIFO, LIFO, and average cost. And you can see that most companies on this pie chart use either FIFO, LIFO, or average cost. Okay, so now we're going to go through this illustration when we are walking through LIFO and FIFO and average cost. If we've got Houston Electronics and they are buying and selling Astro condensers, you can see that at the beginning of this year, January 1st, they had 100 condensers that they had previously purchased for $10 each. And then during the year, in April, in August, and in November, they bought more condensers and put them into the warehouse. So they bought 200, 300, and 400 condensers so that they had 1,000 units available for sale that in total cost $12,000. Their unit costs, each time they bought them, the cost kept going up. So they were buying at $11, $12, and $13 throughout the year. So when we open up the warehouse doors for Houston Electronics, we will see 1,000 condensers that all look the same. Some of them cost $10 for Houston Electronics to buy from the manufacturer. Some of them cost $11, some of them cost $12, some cost $13. And we don't exactly know which ones are which, but what we know is there are 1,000 units that are available for sale. We need to figure out, of these 1,000 units, what are we going to assign to our cost of goods sold, based on the units sold, and what are we going to apply to our what's left in ending inventory? The problem tells us that we actually are selling 550 units, and so that means that there are 450 units that are left in ending inventory. So we're opening up the warehouse doors, pulling out 550 of these condensers to sell to our customers, and then there will be 450 remaining. So first, let's talk about FIFO. FIFO is first in, first out, and basically what it says is that the cost of the earliest goods purchased are the first to be recognized in determining cost of goods sold. So first in, the first units that you buy are the first units that you pull out and apply to your cost of goods sold. And it often parallels the actual physical flow of merchandise because companies like to pull out the oldest condensers to sell them instead of the newest condensers. Companies determine the cost of the ending inventory by taking the unit cost of the most recent purchase and working backwards until all units of inventory have been costed. So let's go through this in the next slide. If we kind of walk through what's going on with our 1,000 condensers, we've got 1,000 units that are available for sale. We sold 550 of them. And so under FIFO, first in, first out, the costs that are being applied to cost of goods sold are the ones that we purchased first. So the ones in January and April, and working our way down. So that means that the items that are left in ending inventory are the newest layers from November and then from August. So we know we have 450 units that are left in ending inventory. And so we're going to assume that all of the 400 units from November 27th are left in ending inventory, left in the warehouse, and those cost $13 each for a total cost of $5,200. And then we need to pull 50 units from that next newest layer from August 24th. And so 50 units of the $12 August 24th costs will also be left in ending inventory. So our total ending inventory cost of the 450 units that we did not sell is $5,800. That means everything else, all of the stuff that was purchased first, all of the units from January, from April, and then the remaining August units are all in cost of goods sold. And you can take your costs of goods available for sale of $12,000, subtract out what you know is left in ending inventory to get to a cost of goods sold number of $6,200. Another way to look at it is in these little boxes right here. If you look at the blue boxes, these are the total costs of the purchases that were made in January, the beginning inventory of $1,000, and then from February, $2,200, from April of $2,200, from August of $3,600, and then of November of $5,200. And so if you kind of look at it from a picture, first in, first out means that the first items that you bought, all of these blue boxes, are applied to the cost of goods sold. These are the units that you're going to put on a truck and sell to your customers. These are the costs of the goods sold that are going to show up on your income statement. And the remaining inventory, the $5,800, will be left in ending inventory and keep on your balance sheet. Okay, so we've talked about first in, first out. Another method is called last in, first out. And basically what last in, first out is the cost of the latest goods purchased are the first to be recognized in determining the cost of goods sold. So it's the last in are the ones that you pull out and assign to cost of goods sold to your customers. This actually seldom coincides with the actual physical flow of inventory because you always try to pull from the oldest. And the exceptions include goods that are stored in piles, such as coal or hay. So if you think about a big old pile of hay, If you're a farmer and you just keep stacking up hay, well, if someone comes in and says, "Hey, I want to buy some hay from you," what you're going to do is you're not going to pull from the bottom, the oldest layers. It's hard to get to the bottom of the haystack. You're going to go, "Okay, I'll sell you some hay," and you're going to pull off stuff from the top. Well, that's the last goods, the last inventory that you put into your inventory, and that's the first that you're pulling out. That's what LIFO is. If we go through the example, the condenser example again, and think about last in, first out, everything that's left in ending inventory is the stuff that's the oldest. So the 450 units of ending inventory comes from the 100 units in January 1st, the 200 units in April 15th, and then 150 of the August units to get to a total of ending inventory of 450 units. And if you apply the total cost, you'll get a total cost of $5,000 for ending inventory. That means that all of the remaining units should be applied to cost of goods sold, which essentially is the November 27th units, the 400 units that are in November 27th, and 150 of the August 24th units. And those cost of goods sold total to $7,000. And again, pictorially, you can see that when you look at the layers, last in, first out means the last items that were purchased. The two bottom squares down there are the layers that you were assigning to cost of goods sold. And then the pinkish layers on the slide are the units that are staying in ending inventory. Okay, so we've talked about FIFO, we've talked about LIFO. Let's talk about the third cost flow assumption, and that is average cost. Average cost allocates the cost of goods available for sale on the basis of the weighted average unit cost incurred. And it applies weighted average unit cost to the units on hand to determine the cost of the ending inventory. Okay, so the way you would do average cost is, if you can see in the top blue box, we've got 1,000 units that have a total cost of $12,000. So those are our goods available for sale. And if you figure out what the average cost per unit is, you take $12,000, divide it by the 1,000 units that are available for sale. So each unit on average, each condenser on average cost $12. Well, if each unit on average costs $12 and you're using the average cost flow assumption, if you've got 450 units that are sitting ending inventory at the end of the sale, you can apply $12 to the unit cost and get a total cost, or total inventory value of $5,400. And then you can do the same thing and multiply the $12 unit cost by 550 units sold, or you can just subtract it from the total cost available for sale. And so your cost of goods sold is $6,600. And to look at this in a picture, we don't have little squares that we're dividing between the warehouse and the truck this time, but what we're doing is we're taking the total units, $12,000 divided by 1,000 to get a total cost per unit of $12, and applying $12 to the 450 units that are left in the warehouse for ending inventory, and then $12 for the 550 units that were sold to get the total cost of goods sold. And the very last slide for this pre-lecture is just to look at some financial information, putting FIFO, LIFO, and average cost in different columns so that you compare the three. The numbers that are in red are the numbers that we have calculated previously. So our ending inventory for FIFO, LIFO, and average cost, you can see, are different. $5,800 for FIFO, $5,000 for LIFO, and $5,400 for average cost. And that would get you, if we've got sales that are similar regardless of which cost flow method is used, your cost of goods sold that you calculated would give you a gross profit that's different in each scenario. That different gross profit would also give you different income before income taxes. So your sales minus your cost of goods sold to get to a gross profit. If you subtract off an operating expense number that is the same regardless of your cost flow method, you'd get a different income before income taxes for each of the three. And that means you're paying different taxes. Under the FIFO method, since our unit costs are rising, our income taxes are higher for FIFO than for LIFO. And so our net income would also be higher because we've got higher income before taxes. So there are some differences that you need to know about between FIFO and LIFO and average cost, and we'll continue this conversation in the classroom.